You finally get that offer you've been waiting for. The buyer loves the place. The inspection comes back mostly clean. And in your head, you're already spending the profit because you're doing the normal human thing where you subtract what you paid from what you sold it for, and you call the difference your win. Then closing day arrives. Your escrow statement looks like a murder mystery. Your tax bill shows up months later, and you realize the government was quietly sitting at the table the entire time. Because when you sell a rental, the tax system does not care about your feelings. It cares about your basis, your depreciation, your holding period, and whether you planned the exit before you signed the contract. My name is Hector, and I help people understand the money mechanics hiding behind big life decisions, especially the ones where a good deal can turn into a disappointing net number. Here's the problem that costs rental owners the most. Most people optimize the sale price and completely ignore the after-tax sale, which is like arguing over the cost of a flight while forgetting the hotel is non-refundable. A rental sale is not one tax event. It's usually multiple tax layers stacked on top of each other, because part of your gain can be long-term capital gain, part can be depreciation recapture, and for higher earners, there can also be the net investment income tax on top, which means your real profit is the number left after a bunch of invisible math you can't negotiate at the closing table. The NIIT, for example, applies at 3.8% once your income crosses certain thresholds, and those thresholds are fixed at $200,000 for single filers and $250,000 for married filing jointly, which matters because a single property sale can push you over the line even if you weren't there before. So in this video, we're going to walk through how to keep more of what you earned by understanding the tax anatomy of a rental sale, by controlling the parts you can control, and by avoiding the common accidental mistakes that inflate taxable gain or trigger taxes you could have deferred legally. The first thing you need is a clean mental model of what you're actually being taxed on, because the phrase profit is doing too much work. The IRS basically starts with your amount realized on the sale, then compares it to your adjusted basis, and the difference is your gain, with special rules depending on what kind of property it was and how it was used, which is why IRS guidance on dispositions focuses so heavily on calculating gain or loss and the character of that gain. Adjusted basis is where most of your leverage lives, because basis is not just what you paid on day one. It's purchase price plus certain acquisition costs, plus capital improvements you made over the years, minus depreciation you took or were allowed to take. And that last part is the trap nobody talks about at parties. Depreciation feels like a nice deduction while you own the property, but on sale it often comes back as depreciation recapture, which is why rental real estate can get hit with unrecaptured Section 1250 gain, taxed up to 25% on the depreciation portion, while the rest of the gain can be taxed at long-term capital gains rates. That means you don't keep more profit by finding a secret loophole, and you keep more profit by shaping three numbers early: your adjusted basis, your depreciation record, and the timing and structure of the transaction. Let's make this feel real with a simple example that matches what a lot of owners experience. Imagine you bought a rental for $300,000, and over the years you put in a $40,000 roof and kitchen upgrades that qualify as capital improvements, while you claimed $80,000 of depreciation. If you sell for $500,000, your brain wants to say the profit is $200,000, but your adjusted basis is $300,000 plus $40,000 minus $80,000, which is $260,000, and now your gain is $500,000 minus $260,000, which is $240,000. Right away, you can see why people get blindsided, because depreciation doesn't just reduce taxes while you own, it can increase taxable gain on the way out, and it can split that gain into buckets taxed differently. Now here's the first way people accidentally overpay. They fail to defend their basis with documentation, which is basically the adult version of losing receipts, and then being shocked the store won't refund you. Capital improvements increase basis, but routine repairs usually don't, and the difference is not what felt expensive. It's whether the cost extended the life of the property or added value in a lasting way. If you replaced a few shingles, that's probably a repair, but if you replace the whole roof, that's more likely an improvement. And if you can't prove it, the safest interpretation wins, which means your basis stays lower and your taxable gain stays higher. So your first practical move, even before you think about taxes, is to gather a basis file that includes your closing disclosure from the purchase, invoices for major improvements, permits when relevant, and a timeline that connects those improvements to dates. The reason this matters is that on sale, you're not arguing with your buyer, you're arguing with math. And the only way to win against math is to make the math correct. The second way owners overpay is by misunderstanding depreciation itself. A lot of people either took depreciation inconsistently or they never took it because they didn't want complexity. And then they learn the hard lesson that depreciation recapture can still apply based on depreciation allowed, not just depreciation claimed, which can create a lose-lose where you miss deductions during ownership and still face recapture logic at sale. The clean approach is to reconcile your depreciation schedule now, not later, because when your CPA prepares the sale year return, they will need accurate accumulated depreciation to categorize the gain properly, and will figure it out later usually means you'll figure it out under pressure. Now let's talk about the biggest lever for keeping more profit, which is not how you file the return, but whether you sell or exchange. A Section 1031 like-kind exchange can allow you to defer gain when you exchange investment real property for other investment real property. And since the Tax Cuts and Jobs Act, the IRS emphasizes that 1031 applies only to real property, not personal or intangible property, which is important because people still carry old myths about exchanging equipment or other stuff. The word defer is the key, because it's not a magic eraser, it's a timing tool. You're basically rolling your gain into the next property by carrying your basis forward, which can be incredibly powerful if your real goal is to stay invested, increase cash flow, consolidate units, move markets, or trade management headaches for something more passive, because you avoid paying a big tax bill right now and you keep more capital working for you. But 1031 only helps if you respect the process, because the IRS treats it like a rule-heavy sport, not a vibe. The exchange must be structured properly, typically using a qualified intermediary, and you have strict timelines like identifying replacement property within 45 days and closing within 180 days, which is why waiting until you're already under contract to think about 1031 is how people blow it up. A like-kind exchange also has a simple economic truth you can't dodge. If you want full deferral, you generally need to reinvest the proceeds and replace the debt or add cash, because taking cash out, called boot, can create taxable gain even inside an exchange. So the decision point is this: are you actually trying to get out and spend the money, or are you trying to move the money into a better investment? If you're trying to exit, you optimize for net proceeds after tax with clean basis and timing, while if you're trying to stay invested, you at least run the numbers on 1031, because deferral can be worth more than squeezing an extra few thousand out of the sale price. Now, not everyone wants another property, and that's where timing becomes your next lever, because your tax rate is not a fixed identity, it's a snapshot of the year you sell. If your income varies, you might be able to sell in a year where your other income is lower, which can reduce your exposure to higher brackets, and it can also change whether you trigger the 3.8% net investment income tax, since NIIT depends on your modified adjusted gross income crossing those statutory thresholds. Timing can also matter if you have other capital losses available, because capital losses can offset capital gains, and while they won't magically erase depreciation recapture in the same way, they can still reduce the overall tax impact in many situations. The point is not to play games, and the point is to treat the sale like a planned financial event that belongs on a calendar, because a rental sale is often one of the largest single-year income spikes people will ever create, and spikes are where taxes bite. Another lever that surprises people is how you structure payments, because some sellers assume the only choices are sell now or don't sell, and there are cases where an installment sale can spread gain recognition over time, which may help manage brackets and NIIT exposure depending on your situation. This approach is not for everyone, and it introduces credit risk because you are effectively financing the buyer, but it's a legitimate tool worth discussing with a qualified tax professional when the numbers are large and your income profile makes timing valuable. Now let's hit one of the most misunderstood strategies, because it sounds like a hack, and it's actually a long game that only works if you plan early and follow the rules. Converting a rental into a primary residence. People hear that you can exclude gain on the sale of a main home, and they assume they can just move in for a little while and cash out tax-free, but the real rules are more specific. The IRS explains that you may exclude up to $250,000 of gain, or $500,000 if married filing jointly, if you meet the ownership and use tests, commonly described as living in the home for at least 2 out of the 5 years before the sale. What matters for you is that a rental doesn't automatically become a primary residence exclusion machine, because there are limitations. and the mechanics get complicated, especially around periods of non-qualified use and around depreciation, since depreciation claimed during rental use can create tax that isn't wiped out by the home sale exclusion in the way people dream about. The clean takeaway is that move in and avoid taxes is not a last-minute trick. It's a multi-year decision with lifestyle consequences, and it can still be a good move for some owners, but only if the numbers justify the time and the trade-offs. Now let's talk about the part that sounds boring, but saves real money, because a lot of rental owners lose profit in the space between the contract price and the net proceeds. And then they lose more in taxes because they didn't realize some selling costs can reduce taxable gain. Real estate commissions, certain legal fees, transfer taxes, title fees, and other selling expenses can affect your amount realized and therefore your gain calculation, which is why it's worth reviewing your closing statement with a tax lens rather than treating it like paperwork you sign and forget. When you keep good records of legitimate selling expenses, you reduce gain legitimately, which means less tax without any heroic strategy. This is also where people get sloppy with allocations when a sale includes more than just the building. If you're selling a property with appliances, furniture, or other personal property bundled into the deal, the allocation between real property and personal property can affect the character of gain and depreciation recapture, and the wrong allocation can create a tax outcome you didn't intend. You don't want to invent numbers, and you do want a defensible allocation that matches reality and is consistent across buyer and seller reporting, because inconsistent reporting is the kind of thing that creates questions later. Now, the fifth and final way to keep more profit is to avoid what I call accidental taxable events, which are the little decisions that are not illegal but are expensive. One example is selling in a panic without understanding whether you're selling an investment asset or inventory. If you behave like a flipper, with short holding periods and a pattern that looks like you're in the business of selling property, the tax treatment can change in ways that are usually worse than long-term investment treatment, and that's why the IRS highlights that property held primarily for sale does not qualify for like-kind exchange treatment. Another example is treating refinancing proceeds like tax-free profit and then being shocked when you sell. Refinancing itself is not a sale, so it can feel like you got money out without tax, but that doesn't erase gain, and it can increase your risk if you use the cash and then owe tax later without enough liquidity. Another example is ignoring state and local taxes, because even if you understand federal tax, state rules can materially change your net, and in some places the state bite is large enough that it changes whether a 1031 exchange is worth the hassle. So what does a smart, practical process look like if you want to keep more of your profit without turning your life into tax paranoia? First, before you list the property, you build your basis file and you reconcile depreciation, because you want accurate numbers, not guesses, and you want them early so you can plan structure. Second, you decide whether your goal is exit or reinvestment, because that determines whether you should seriously explore a 1031 exchange, which the IRS describes as applying to exchanges of real property held for productive use in a trade or business or for investment. Third, you model the sale in at least 2 timing scenarios, like selling this year versus next year, because your marginal tax picture can change dramatically with one calendar decision, especially with NIIT thresholds sitting there like a trapdoor. Fourth, you review selling costs and allocations with the same seriousness you apply to negotiating the purchase contract, because basis, expenses, and allocations are where paperwork turns into money. Finally, you treat the signature as the end of negotiation, not the start of planning, because once you're under contract, your options narrow fast, while before you list, you still have real control over structure, documentation, and timing. Tax rules are detailed, fact-specific, and they change over time, so you should use this as a framework for smarter conversations with a qualified tax professional rather than as personalized advice for your exact situation. The goal is that the next time you think about selling a rental, you don't just ask, "What can I sell it for?" and you ask, "What will I actually keep?" Because the difference between those two numbers is where most of your profit quietly disappears, and once you learn to see the levers, you stop being surprised by the bill, and you start being the person who planned for it before the buyer ever walked through the door and fell in love with the living room.